We're trying to make some sense here, Dan, I guess, as to whether things have gotten out of control or maybe what we're seeing in the market right now, I guess, is representative of where it should be.
Well, I mean, clearly Santa Claus has showered this market with a lot of good joy and cheer for the Christmas season. It's going to end up on a big boom, but of course on low volume. When the adults come back after the new year, we'll see whether or not this risk-on environment is going to continue. But from a macroeconomic standpoint, the economy is actually slowing down somewhat. One of the things that was very stunning, if you go back to last Thursday's personal income and outlay data, you saw a slower but still very robust continuation of the pickup in personal spending. But on the other hand, you saw personal income begin to subside, most particularly if you strip out a pickup in sort of one-time payouts to nonprofits through some of the healthcare reimbursements attended to COVID. Really, personal income only went up about 0.27% as opposed to the 0.4% month-over-month number shown in the headline. So what you're starting to see is this spread between spending and income growth. And that's got to close, or eventually consumers are going to run out of all of that savings that they accrued during the 2 years of the pandemic. Now, of course, I think we all have to come to our own judgment, those of us who are in the market, as to whether or not Washington is going to cook up another band or another bunch of relief. I don't think that's likely. I don't think it's likely given the pressure that we know is already built up around Build Back Better. So I don't think we're going to get the kind of relief around Omicron that we saw in prior waves of this virus. And then, of course, you have to deal with Omicron. I'm in the UK right now. I was in France earlier in the week. This is a real economic crimp. And you're about to see you're already seeing 3 of the 4 nations in the UK announce some shutdowns beginning shortly. And I wouldn't be surprised if you see that in England as well. Certainly France is heading towards more lockdowns. It won't be the same as in past rounds of the virus, but it's still going to have an impact on the services side of the economies.
So, Dan, give us your sense of inflation here. This is a raging debate. It's there. It's tangible. Consumers are feeling it. What is your sense of how much of a headwind that could be for the markets in 2022?
Well, it's very interesting. It's the big debate going into the first quarter of the year. What's going to happen with inflation? My view is that inflation is going to surprise us to the downside. We had a huge oil spike earlier in the year. That subsided simply because the supply and demand realities of oil were out of whack. OPEC was not going to continue to hold back supply given the very attractive prices it could sell at. And clearly, from a global perspective, we don't have a shortage of oil anywhere near the kind that we did earlier in this century. We just don't have the demand sufficient to push the price up into the 80s on a sustained basis. So price is going to settle back. And obviously, energy is a huge input throughout both the goods and services side of inflation measures. So that, I think, is going to have an impact. But the big issue, I think, that's going to surprise people in the first quarter is we're going to see a more accelerated cure to the supply chain problems that we saw the last couple of quarters. A lot of them due to the fact that we had almost a perfect storm of demand of Christmas restocking for stores, as well as all of the revenge spending that was coming through during the summer. And so as a practical matter, I think we're going to see most of the supply chain, if not all of it, resolved by the end of the first quarter. And that's going to bring back significant disinflation from the import sector. So my view is that the bond market is actually reading things quite accurately, and that the chance of the Fed raising rates multiple times next year, at least as many times as the market has so-called baked in, I think is fairly low.
Yeah, in the bond market today, you're looking at 71 basis points on your 2-year yield. That's going higher, and your 10-year yield going down here as a lot of folks sort of prepare themselves for whatever they get out of the Fed next year. A lot of people penciling in March. I am curious about the labor side of this equation. When you talk about fighting inflation, when you talk about economic growth or the lack thereof, the labor force, the number of people in the labor force, and what we're paying those people in the labor force have to be a big part of the equation, Dan.
Yeah, and we're still down somewhat under 4 million workers from where we were. If you add to population growth to that figure, you could call it 5 million workers from where we should be in terms of apples and apples to pre-pandemic. And many of those workers did not return to work because of viral concerns, and clearly Omicron is not going to help that. But the larger issue, I think, that drove the drop in labor force participation was clearly the fact that we had really unparalleled assistance to people who suffered during the couple of years of the pandemic in terms of government relief. And that built up an enormous buffer for people, especially at the low end. And they had the option of whether or not they wanted to stay out of work for a considerable period of time. That buffer has been eroded. And I think coming back after the new year, we're going to see a lot of people return to many of those positions that could be slowed somewhat due to Omicron. But, the offsetting factor there is that you may have some problems on the labor side with Omicron. You're also going to have some problems on the demand side because of Omicron. I mean, you're not going to see hotels fill the way people expected with meeting business and business travel. You're not going to see restaurants filled. So, those two things are going to really offset each other.
So, Dan, as you think about 2022, I know a lot of folks are trying to wrestle with, on the equity side, do I stick with that growth story, the top line growth stories that have worked so well for so long? I'm thinking Apple, Amazon, those types of things, or that rotation trade, that cyclical trade, whether it's energy or banks that have really performed well during this pandemic as people think about, all the stimulus and perhaps reopening of this economy. How do you think about that?
The big thing, in the banking sector, I think the issue is will the consumer go out and borrow, right? And that is going to require fairly sustained confidence on the part of the consumer in future wage growth and income growth. We've seen a huge spurt, particularly at the low end, in hourly wage growth, not so much in hours worked. Some of that we might lose because some of that came across in the form of signing bonuses and some overtime. But at the end of the day, most of it will stick. But that's not going to be repeated. It's very unlikely to be repeated, in my opinion. And so the concept of a wage price spiral that a lot of people have thrown out there, I just don't think is going to happen. We don't have the demand side wired for that at this point. And I think that when you look down the pike into next year, the top line growth that you saw was clearly the result of a huge amount of government finance demand. I mean, government transfers were off the charts relative to any other period in history in comparison to private incomes. And so that's not being repeated next year. And so the question is, you're putting a lot of pressure from a macroeconomic standpoint on the private sector to make up the difference. And thus far, we're still hundreds of billions of dollars on an annualized basis in private sector incomes that have not recovered relative to the huge amount of government transfers that flowed in. So that's going to be very, very difficult, and we might get there. But it's going to take some time.
Dan, I want to get your thoughts here. I mean, just drawing on your expertise in the past and in the real estate space here, and how commercial real estate sort of holds up in this environment with so much talk about potentially hybrid work being a big structural change coming out of this pandemic, the need for less office space here. How do you look at that space as an investment? Is it still attractive?
I mean, that's the big $64,000 question. If you look at where we're at in this particular crisis, that's either something that's going to resolve itself, or it's really truly going to turn out to be the slow-moving train wreck of 2022. This situation with Omicron, I think, is going to be a huge setback to the office market. Retail market obviously is a complete disaster already, bricks and mortar retail. It's going to, I think, reignite pressures on the hotel industry, as you know, all of the business travel and meeting business that people thought were going to recover in the first quarter won't recover, at least not immediately. But the office sector is the one that really is going to be very, very difficult to see recovery in, and of course all the related service and retail that serves the office market. It's going to be very difficult to see how that is going to return to any form of normalcy in 2022. And, you know, to the extent that people have let the genie out of the bottle, we've all discovered how we can work. I mean, here I'm sitting in Oxford, England, having a chat with you. I could just as easily be holding a board meeting. You know, the idea that that we can all work this way, that genie's not going to go back in the bottle. The
Anytime
use
soon,
of space, the use of existing space, I think, is going to be far lower, and that market is going to have to reprice itself.